Let's find some juicy deals in the stock market, people. What is happening, investors? It is your boy Jack. I am not a financial advisor. I got the t-shirt to prove it. And today we're going to be speaking about some undervalued stocks. To be honest, guys, there's only so much your brain can handle at looking at Workhorse, Hyliion, Neo, you know, the big tech stocks. You need to change it up every now and again. And I want to become a better investor. I want to become a more well-rounded investor to provide you guys with more valuable information. So I decided to start looking into some more value plays. And it's been refreshing. It's been interesting just looking into some different sectors, some different companies. It's actually been fun. But guys, I have to thank you all so much. Yesterday on the channel, we got over 45,000 views on a day. For reference, our best day before that was something like 27,000 views, so the support was crazy. I appreciate you all so much. We also went up something like 800 subs in a day. You guys are blowing my mind. I appreciate you all from the bottom of my heart. I really can't comprehend that. I really can't, but just know I am extremely appreciative, people. So right before we get into the video, can I please ask you to smash a juicy like, as it genuinely helps me and the channel out so much. I'd really appreciate it. If you're new around here, hit that juicy red subscribe button, people. Join the family. We're 23,000 investors strong. And drop me a comment down below. Let me know what you think of any of the companies we speak about today, or if you have any other value plays that are on your watch list right now. I'd be really interested in hearing from you guys. With that being said, let's get into our first company of the day. So guys, the very first company we're going to have a look at today is actually Darden Restaurants. So it's in the name. We're having a look at a restaurant stock. And I was going to speak about Cheesecake Factory, okay, because that is another restaurant stock that I am looking into quite a lot right now. But I know a lot of people have covered that already. So I wanted to try bring some different ideas to you guys. Now, I may well still cover Cheesecake Factory in the future, but this was another company I found while researching restaurant stocks that I personally thought was really interesting. I was trying to look at some of the biggest restaurant chains that were out there, okay? And obviously, we have Subway. They're not publicly traded. We have McDonald's. I have a small position in McDonald's already. I also think they're a good company. We've Starbucks. I don't think they're necessarily of the best value right now. Then we have companies like KFC and Burger King who are owned by Yum. And then we have a company like Domino's, you know, whose stock price has already run up so much. And essentially, I looked through an awful lot of these companies, and I didn't like most of them at current valuations for one reason or another. And eventually I got to Darden Restaurants, and I have to say, guys, I really do like the look of this company and their current valuation. If we look on the 6-month chart, we can see that we're still down 30% from where we once were. Now, this isn't necessarily an anomaly when it comes to restaurant stocks. A lot are doing way better, a lot are doing a little bit worse, but overall, we're still down over 30%. With that being said, guys, from the bottom, these guys are up over 146%. So these guys got hit absolutely incredibly hard, okay? So since things have started to somewhat get back to normal, Darden Restaurants has had an absolutely incredible recovery, but we can also see that for, you know, since June pretty much, we've been trading very sideways. Not a lot has happened whatsoever. And because of that, we are still down 30% on that 6-month chart. Now, if we go to the 5-year chart, we can see decent growth, okay? So pre-crash, they were up pretty much 100%. They were up over 100% at one stage. All the time, they were also paying pretty much a 4% dividend, which is very nice when we see that level of growth. Since then, the dividend has been cut for very obvious reasons. And if we go back a little bit further to the Mac stock chart, I mean, the growth's been absolutely incredible. Again, restaurant stock got hit incredibly hard coming out of the Great Recession. If we go from the very bottom, we then went on an absolutely beautiful run. I mean, in the matter of a few years, up over 200%. If we go all the way up to our next highs, we were up over 700%, people. Restaurant stocks do get hit extremely hard. Some take longer to recover than others, and that's not necessarily a bad thing. It can give investors more time to get involved. We have a look at a company like Domino's, for example, okay? And they strive off of, you know, either takeout or deliveries. You don't go to Domino's and sit down for a meal very often. You get it delivered or you take it out. So it's clear to see why a company like Domino's wouldn't have had anywhere near as considerable a dip, because they just got back to normal business, and they even improved business very quickly. So this is a good thing for current Domino's investors, but if we're value investors and we're looking for something, you know, that's been beaten up relatively unfairly, that has the potential to go back to its previous rates of growth, this isn't really what we're looking for. Something a little bit more like this is. Now let's get into some of the more financial stuff. One really quick piece of information from the Motley Fool. The market may be too pessimistic though. Darden shares trade at 26 times estimated earnings for fiscal 2021, which began in June, okay? Even though Wall Street expects the restaurant operator to grow earnings at over 26% annually for the next 5 years. That's some very, very nice growth, people. And in regards to Olive Garden, okay, it was one of those restaurants that had a long established off-premises business already in place, and takeout orders tripled. Through the first 3 quarters of fiscal 2019, about 50% of Darden's total sales came from the Italian chain, the Olive Garden. But potential investors should be encouraged that this important chain is also Darden's top performer. It's their top performer, it brings in most of the money. We're about to get into their Q2 earnings in just a moment, but first of all, let me show you this. So in the Q3 earnings call, it updated investors that it fully withdrew a $750 million credit line, resulting in approximately $1 billion in liquidity. Since then, it secured another $270 million term loan that is also fully withdrawn. Darden's management said its cash burn would be around $40 million per week in a zero revenue situation, giving it enough cash for around 7 to 8 months. However, it is not in a zero revenue situation. By continuing to generate to-go revenue, reducing capital expenditures, and putting its dividends on hold, its current burn rate is around $25 million a week. So as long as restaurants can fully reopen by 2020, which seems reasonably optimistic, we'll live to see way better days. And I think at this stage, a lot of people do have the expectations that, restaurants will be back to normal relatively soon. Now, normal might not be the old normal, but we'll be back to some sort of reality. Then we take a little look at their fourth quarter, okay, and the full year results. So in the fourth quarter, sales decreased 43%. Now in the fiscal year 2020, total sales only decreased 8.3%. So all in all, we were on for a good year before this all started to happen. And this is what we want to look at when we're looking for these value plays. We want to look at companies who were in a good position and then due to circumstances outside of their control got beaten up. That essentially means we're going to get in at a cheaper price, and when things get back to normal, we should just continue to grow. And an update on what we just said about their liquidity position through what we knew after Q3, the company now has access to over $1.5 billion of liquidity. They're going to be absolutely fine for a very, very long time, people. So the fiscal 2021 first quarter financial outlook. Total sales of approximately 70% of prior year sales. I think that would be absolutely fine if we are to get there. EBITDA of at least 75 million. Diluted net earnings per share from continuing operations greater than or equal to $0. That's a fair goal to have right now considering the situation. And one exciting thing is additionally for the full year, the company expects to open 35 to 40 net new restaurants and have total capital spending of $250 to $300 million. The fact they're in such a tough time and we can have these expectations, that fills me with confidence for one. And I want to show you some of their more historical numbers, okay? So if we look at operating results, it was going up nicely every single year since 2016. Between 2017, 2018 and 2019 in particular, they were all very good years growth-wise. And then obviously in 2020, we've started to see things go down. But again, we have to look back in history and see how things were going beforehand, and it was very good. The number of restaurants had been going up steadily, and even into 2022 it did. The number of employees alongside that has been going up. Obviously now 2020 there's been some cutbacks, but it hasn't been terrible by any means. And their dividends were also going up quite nicely, people. Now of course they did have to cut that dividend, but I would fully expect it to come back one day. It generally will with these value stocks, and I still just think that they have quite a lot of avenues. I think they're going to be absolutely fine, people, and I do see at these current price points nice growth prospects over the span of a couple of years. Now the primary concern I'd have here is our current assets are only at 1.1 billion, okay, and then our current liabilities are at nearly 1.8 billion. It's obviously not what you want to see at all, but not everything's going to line up perfectly most of the time. Their total assets on the other hand are just shy of 10 billion and their total liabilities are about 7.6 billion. So I mean, given what we just saw from those quarterly earnings, the amount of liquidity they have and they can get if needed, I'm not actually particularly worried about the asset to liability issues as of right now, but it is something that if you do plan on getting invested in, watch this very closely over the next quarter or two because it will be very important from a long-term point of view. And I just want to make it quite clear right now, people, I'm not invested in this company just yet. I'm still doing my research into restaurant stocks in general, but this is just one of the more interesting ones I personally found. Okay, so that's where we're going to leave Darden for now. Very interesting company. Two more. So this next one, Dan stock, okay, Dana. Very interesting company. We briefly spoke about them well over a month ago, and a lot of you guys may be aware of who these guys are because of Hyliion. But there is a whole lot more to this company than Hyliion, and I have to say, this one looks very exciting to me. On the 6-month chart, okay, we can see that we're still trading down about 22.17%. We have a share price of $13.83 currently, and from the very bottoms, we're actually up over 220%. Now, if you aren't aware of this company or what they do at all, okay, they're an American supplier of axles, drive shafts, transmissions, and electrodynamic, thermal, sealing, and digital equipment for conventional, hybrid and electric powered vehicles. So these are the guys who, give the components to some of these big EV players. Now, a lot of people found out about this company from Hyliion because in their investor presentation right here, you can see their strategic partners and financial investors, okay? And we see Dana's logo, electric drive components and manufacturing. They're an industry-leading supplier of drivetrain axles and electrified propulsion components. And so what Dana is doing alongside Hyliion is co-development of strategic components, supply chain, full system assembly, sales and marketing, and OEM partnerships. And let me tell you guys, these guys have been around for a long time. Look at this, 115 years of innovation, 1904. Clarence Spicer starts his company on April 1st, 1904. 1967. Dana conducts experiments of driveline concepts for electrical vehicles decades before the production of hybrid and electric cars. They have been around the block for a long time, people. And before we get into some of their presentations, etc., I want to show you their balance sheet, okay? And what I want to show you is their current assets are currently at just over 3 billion. And if we go down a little bit, their current liabilities are only at 1.379 billion. So that is quite a nice ratio to have given the times we're in, people. It really, really is. And so to me, to see that, first of all, that current asset to current liability ratio on a company who is still down well over 20%, well, a little over 20%, that's a very good first sign. Now, if we go to their 2020 second quarter earnings conference call, that came out July 30th. Now, if we have a quick look at the business overview, the first thing I want to show you is this, the monthly sales progression. May up 83%, June up 85%. The growth has been quick. Adjusted EBITDA at about break even and diluted adjusted EPS negative 69 cents. Key highlights: reopening completed, new electric truck program win, acquired EV software capabilities, the Hyliion partnership, and the Ford Bronco reveal. So I mean, this little page here just gives you a lot of information straight away. So new business, European electric truck, Dana's third significant electric truck program, the complete Dana e-powertrain. So it's a multi-year program and it's launching in 2021. So they have quite a lot going on now, but they're still looking towards the future, which is something I always love to see in a beaten down value play. They obviously have the Hyliion partnership, which I believe will be very important in the short term. I made a video on Hyliion yesterday, okay? The last 2 trading days, these guys were up over 22%. Pre-market, as of recording this video, they're up over 8% again. Now, Hyliion is only one of many aspects to Dana, but still, seeing something like this come into fruition is very good. Ford Bronco. I know a lot of us workhorse investors don't like to speak about Ford at all, but when we're having a look at Dana, this is important. Near-term financial priorities. This is going to be very important when deciding whether or not we believe we can invest in this company now. So actions have been taken to reduce inventory by $77 million. Throughout the shutdown period, reduced hourly and salary labor costs and reduced operating costs in line with lower volumes. Capital spending reductions continued in second quarter, negative 35% year over year. Temporary dividend suspension preserves additional flexibility. I'm happy to see this. Issued $500 million in new senior unsecured notes. Terminated an undrawn bridge facility, again a good thing to see, and repaid a $300 million drawn on revolver. So reduced material orders, flexible conversion costs, scaled back on capital spending, and suspended the dividend. All good things given the situation we're in right now. I know a lot of people want their dividends. I would rather the growth. So Q2 liquidity ultimately is at $1.7 billion. Now sales Q2 year over year, down massively. Pretty much everything that we want to see going up is down massively, but it's for very understandable reasons, people. You all more than likely know that Q2 was a terrible quarter for pretty much any EV related company at all. Even if you look at the massive players such as Tesla, it was not a good quarter. Now, after issuing these senior notes, which was important, we're sitting at a positive total cash flow. So this is a little bit of what the business outlook is actually looking like, okay? There's strong light truck demand. Quite clear to see why. We've just seen so many coming to market. The Class 8 demand is soft, but the order rates are improving. And the agriculture equipment market is outperforming. Let's just say that's because, agriculture is an essential business, so they would have just gone along as normal pretty much. But all in all, everything's looking okay. So this is a company where when we have a look at the max stock chart, it's been a little bit of a weird journey. It's been a little bit all over the place. And even when we look at the 5-year stock chart, we can see that we really started to peak in 2018 and it's been somewhat down since. But given the current market, given what we have seen happening, given the balance sheet, given everything that's going on, I do think this could be a fantastic value play. I think that time is on Dana's side, which is important with our value plays. And I also think that right now, the sector that they're involved in obviously has a whole lot of hype behind it And Dana is a company who hasn't necessarily kept up with the hype because, you know, they're not one of the big companies that everybody speaks about. They don't have the same hype as a Workhorse or a Hyliion, and they more than likely don't have the same growth potential as well, but I would say that the risk is considerably less. But that is Dana, guys. Do with that information what you will. Again, a full disclaimer, I'm not invested in this company just yet. I may well be though. Okay, and we have one more company, and this is one that a lot of you actually will be familiar with if you've been on this channel for a considerable period of time. We're actually going to be having a look at Altria stock, people. So look, I know there's a whole lot of mixed opinions about this company given the pure fact that they're in tobacco. I know a lot of people can't invest in tobacco, etc, etc. That's fine, everybody to their own. Everybody's entitled to their own opinion. The last month, not a lot's really happened at all, okay? On the monthly chart, we're up 2.41%. We've been down a little bit, we've been up a little bit, it is what it is. On the 5-year chart, okay, if we go from exactly 5 years ago, we're actually down 21.13%, okay? I want you to remember, this company has a dividend yield of 8%. So I mean, obviously that's not what you want to see. You don't want to see 21% of your value gone. That's a terrible thing. But their massive dividend did to an extent account for it. Now, it's had loads of bumps in the last few years. On the 1-year chart, I do like to see the fact that pre-crash we started to make a very nice move to the upside. Then the crash happened and Altria got hit about as hard as everybody else, okay, down just under 40%. Since then, the recovery has been lacked. It's been lacking. They were only up 35.5%. Now, not that that's bad, but I mean, it's not as good as a lot of other companies have seen. We're still down just over 15-ish% or so from the previous highs. And when I say the previous highs, I mean the 6-month highs. I'm not talking about all-time highs, etc. I see a lot of potential in this company though. I really, really do. Seeking Alpha has this great article, okay? Altria. They hiked and increased income against all odds. Q2 2020 results were better than expected for Altria, and it even hiked its dividends. In the time we're in right now, after losing so much value on their shares, they're in the position where they can increase their dividend. And keep in mind, guys, these are a dividend king. They've been paying and increasing these dividends every year for more than 50 years. Seeking Alpha is saying Altria is a strong buy for its income prospects, and it's a buy and hold for the long run. And again, guys, that's generally what a value stock is. It's something you just buy and hold for a very long time. And if you can get a value stock that has really good growth prospects, and alongside that, an incredible dividend yield, that's like the win-win-win. They say they are buyers at the current price but would not chase beyond $44 a share. Q2 2020 results. Altria reinstituted guidance for the year after having it withdrawn in Q1 2020. Just having guidance for the year speaks a lot, guys. It speaks volumes. It doesn't even matter what the guidance for the year is, but the fact that they have guidance, that says a lot. They now expect adjusted EPS to come in between 421 and 438 for this year. This would be a growth of 0% to 4% over 2019 adjusted EPS numbers, which is impressive given the current recession, to say the least, people. And in light of the fact that world GDP is due for a remarkable drop in the range of 4 to 6%. They've been getting hit hard for a long time, not just before this little crash. They've been getting hit for a long time, and they're performing. Altria has expanding margins for the first half of the year, which is expected to continue. Very good. These were some of the strongest margins in recent times, and Altria's cost control and price hikes are delivering better results for its shareholders. I mean, guys, the fact that Altria, okay, a company who already has an 8% dividend yield, was able to hike their dividend given the times we live in right now. Look at this graph. The number of public US companies cutting or emitting dividends January 2004 through May 2020. Look at this. The Roni recession. Look at the Great Recession. Look at how many companies have had to cut or completely get rid of their dividends. You'll already be aware of this, guys. I mean, this has happened to numerous companies that are very, very popular. Dividend investors have not been having a good time in general. So the fact that Altria has been beaten up so much and is still in a position to do this, fantastic. So I've spoken about Altria a few times in the past, okay, and there's a few things about the company that get me excited, okay. Traditionally, they've sold cigarettes. That's what they've done, blah, blah, blah. We all know this at this stage. They are expanding their horizons. They're looking to the future, which, as I said earlier on in the video, that's something that to me personally is extremely exciting. And this here in particular, the IQOS. It has FDA approval behind it. 2020 would likely show bulls the numbers they had long anticipated from this segment. However, the rollout has slowed significantly from the prior projections, okay, it's obvious reasons. Even so, initial results have still been quite positive, and Altria is rolling the product out in a disciplined manner along with learning from each of its local launches. So what the IQOS actually is, it isn't a vape or a cigarette. It heats tobacco but doesn't burn it, and is designed to give users the same rush of nicotine as smoking with fewer toxins. And this does have FDA approval, it is out there now. You're all more than likely aware that they're in Juul. That hasn't worked out very well for them, but they're constantly exploring new avenues for growth going forwards. And if you go to their investors at a glance page, okay, this is their strategies for long-term growth. Maximize income from our core tobacco business. I mean, this is what Altria does, and it's what they have done for literally decades. They have to keep doing this, but they want to grow their income over time with non-combustible tobacco products, IQS, Juul, etc., and manage our diverse income streams and strong balance sheet to deliver consistent financial performance over the long term. We can actually see that their reported diluted EPS for the 6 months ended June 30th is actually up 13.3% year over year, and for the second quarter it's only down 2.8%. All in all, guys, given the situation, that's good. But guys, that is the third company. It is Altria. I know a lot of people have different opinions on investing in this company, etc, etc, but it is one that I actually do own. Now I will be honest, it's a very small position, but I do honestly plan on buying more at these prices. How much more? I'm not sure just yet, but I do plan on buying more. I just think that the growth prospects and the dividend yield combined at these current prices is too good for me to pass up. But guys, there we have it. 3 juicy little value plays for you guys to go and do some more due diligence on yourself. But guys, there we have it. I do really hope that you enjoyed the video and you enjoyed me speaking about some kind of different companies that we haven't spoken about a lot, because I know I do spend an awful lot of time on EV and tech in general, but at the end of the day, they still are my biggest interests. And again, I want to thank you all so much for the insane support on the channel as of late. I am putting an awful lot of work in, but you guys are making every single second worth it. I mean, the support is crazy, it's overwhelming. I appreciate you all so much. If you have watched until the end and you have taken some value from today's video, please do consider hitting that juicy like button for me, dropping me a comment and hitting the subscribe button, because those things do help me out so much and it makes it all so worth it. But anyway guys, I won't keep you any longer. I hope that you all have an absolutely fantastic day. I will see you for tomorrow's video. Peace.